the early 1960s, finance had a hole in the middle. Investors knew risk mattered. They knew diversification mattered. Harry Markowitz had already shown that a portfolio was not just a basket of good stocks, it was a machine. Expected returns went in, variances went in, co-movements went in, portfolio weights came out. That was a revolution. But it did not answer the next question. If every smart investor diversifies, why should one stock earn more than another? That question sounds small. It is not small. It is the question behind every benchmark, every cost of equity estimate, every index fund, every active manager pitch, and every argument about alpha. Before CAPM, people talked about a market risk premium as if it simply appeared. Sharpe's 1964 paper called out the gap. Finance had models of investment under certainty. It had Markowitz's portfolio selection under risk, but it did not have a clean equilibrium theory for the price of risk. The capital asset pricing model gave one answer. It said, the market does not pay you for all risk. It pays you for beta. Pause on that. Not all risk. Beta. That is the whole episode. Imagine two stocks. One is a wild small company. It has lawsuits. It has bad product launches. It has noisy quarterly earnings. Its stock chart jumps around. The other is a boring company. Nothing dramatic happens most days. But when the broad market moves, this stock moves with it. Which one should earn more? The naive answer is the wild stock. It looks riskier. But diversification changes the question. If the wildness is company-specific, you can own many stocks and make that risk fade. One firm has a lawsuit. Another firm has a lucky product. A third misses earnings. A fourth beats them. Inside a broad portfolio, those shocks can cancel. They are not free to bear if you hold only one stock, but they are diversifiable if you own the market. So CAPM asks a sharper question. What part of this stock's risk cannot be diversified away? That part is market risk. Beta measures it. This is why CAPM was not just another formula. It changed the unit of risk. It moved finance away from raw volatility and towards systematic exposure. Now meet the four ingredients. First, the risk-free rate. That is the return for waiting. It is not payment for taking stock market risk. In the formula, call it R sub F. Second, the market return. That is the expected return on the broad, risky market. In the formula, call it E of R sub M. Third, the market risk premium. That is E of R sub M minus R sub F. It is the extra return investors expect for owning the market instead of the safe asset. Fourth, beta. Beta is the stock's sensitivity to the market. A beta of 1 means the stock tends to move like the market. A beta above 1 means more market exposure. A beta below 1 means less. The formula is not asking whether a company is exciting. It is not asking whether a business has a great story. It is not asking whether the CEO sounds convincing. It asks one cleaner thing. How much market risk does this asset carry? Now write the formula. E of R sub I equals R sub F plus beta sub I times the quantity E of R sub M minus R sub F. Read it slowly. Expected return equals safe return plus beta times the market premium. That is the capital asset pricing model. If beta is 0, expected return equals the risk-free rate. The asset has no market exposure in the model. It does not ride the risky road. If beta is 1, expected return equals the market return. The asset moves like the market. It earns 1 full market premium. If beta is 2, expected return gets 2 market premiums. It carries twice the market exposure. The formula is a straight line. That line is the security market line. The vertical axis is expected return. The horizontal axis is beta. The line starts at the risk-free rate. It rises with the market premium. Every fairly priced asset should sit on that line. If a stock plots above the line, it offers more return than CAPM says it should for its beta. That is the beginning of an alpha claim. If it plots below the line, it offers too little return for its beta. That is why CAPM became the first ruler. It made alpha mean something. Alpha is not just good performance. Alpha is what remains after beta has been paid. Now use small numbers. Assume the risk-free rate is 3%. Assume the expected market return is 8%. The market premium is 5%. Stock A has beta 1.3. CAPM says 3% plus 1.3 times 5%. That equals 9.5%. Stock B has beta 0.6. CAPM says 3% plus 0.6 times 5%. That equals 6%. Stock A needs a higher expected return, not because its story is better, not because its CEO is smarter, not because its product is more exciting, because it carries more market exposure. The formula turns exposure into a required return. This is also why CAPM became so useful in valuation. When an analyst estimates the cost of equity, CAPM gives a disciplined starting point. A high beta company should face a higher required return. That higher required return becomes a higher discount rate. A higher discount rate lowers the present value of distant cash flows, so beta reaches straight into valuation. It changes what a future dollar is worth today. It also changes how you judge active managers. Suppose a fund beats the market in a bull run. That sounds good. But if the fund carried high beta, it should beat the market when the market rises. That is not skill by itself. It may be more exposure. CAPM tells you not to clap too soon. Ask how much beta the manager carried, then ask what return remains after beta has been paid. That remainder is the hard part. That is alpha. But CAPM has a wall. The wall is not philosophical. It is empirical. In 1992, Eugene Fama and Kenneth French tested the cross-section of expected stock returns. Their result hit CAPM at the center. When they allowed beta variation unrelated to size, the relation between beta and average return was flat. Size and book-to-market explained more. That did not erase CAPM. It changed the job of CAPM. CAPM became the null model. Draw the beta line first, then ask what else matters. Value, size, momentum, quality, liquidity, profitability, investment, and other factors all had to face the same question. Are they true reward? Or are they beta in another coat? That is a powerful discipline. CAPM is wrong if you treat it as the full map. It is useful if you treat it as the first ruler. Every serious investment process needs a first ruler. Without a baseline, every return looks like skill. With a baseline, return has to explain itself. Did you earn more because you had insight? Or did you earn more because you rode more market risk? That is the enduring value of CAPM. It forced finance to separate exposure from skill. It gave index investing intellectual force. It gave active management a hurdle. It gave corporate finance a discount rate starting point. It gave investors a way to ask for receipts. This matters most when the story is seductive. A fund manager can say, "We beat the market." CAPM asks, "How much market exposure did you take?" A founder can say, "Our company deserves a high valuation." CAPM asks, "What return does the equity holder require for this risk?" A stock picker can say, "This stock is cheap." CAPM asks, "Cheap relative to what risk?" That sounds cold. It is supposed to be cold. The point of a benchmark is not to flatter the investor. The point is to remove excuses. If a high beta stock rises more than the market in a bull run, that may be exactly what beta predicted. If it falls harder in a drawdown, that may also be exactly what beta predicted. CAPM does not say the stock is good or bad. It says the stock has a measurable exposure. That exposure has a price. This is also why the model changed fees. If beta is cheap to buy through an index fund, then active managers must justify their fee with something beyond beta. They must show selection skill. They must show timing skill. They must show a factor exposure the client actually wants. Or they must admit they are selling expensive market exposure. That is why the alpha versus beta split became so powerful. It took a vague boast and made it measurable. But the model also teaches humility. The Fama-French result does not mean beta is useless. It means beta is not the whole reward system. Markets are not one-dimensional. Stocks can be cheap because they are distressed. Small firms can carry different risks. Value firms can behave differently from growth firms. Momentum can persist. Liquidity can vanish. Quality can matter. CAPM gives the first line. It does not give the last word. That is the mature way to use it. Draw the beta line. Measure the baseline. Then ask what remains. Here is the habit to keep. Every investment return has to pass through 3 gates. The first gate is cash. What would you earn for waiting without taking market risk? That is the risk-free rate. The second gate is beta. How much broad market exposure did you carry? That is the part CAPM prices. The third gate is evidence. What remains after cash and beta have been paid? That leftover return is where the hard questions begin. Maybe it is skill. Maybe it is value. Maybe it is size. Maybe it is momentum. Maybe it is a hidden risk factor. Maybe it is luck. CAPM does not answer all of those questions. It forces you to ask them in the right order. That order matters. Without it, any rising stock can look brilliant. Any bull market manager can look skilled. Any high beta strategy can wear the costume of alpha. The formula strips away the costume. It says, first pay beta, then talk about skill. So the formula is simple. Expected return equals the risk-free rate plus beta times the market premium. The meaning is deeper. The market pays for risk you cannot diversify away. It does not owe you a premium for every frightening thing inside one company. Tomorrow, when a stock or strategy promises higher return, ask one question first. Is this skill, or is it just more beta?